Well, the Fed is also in focus here. Fed Chair Jay Powell saying overnight that he's monitoring the banking industry, quote, very carefully, while staying hawkish on the central bank's policy. At an event held by the Spanish Central Bank, Powell once again signaled that more rate hikes are likely necessary to get a better handle on inflation. We want to bring in Kevin Mahn, Chief Investment Officer at Hennion Walsh. Kevin, it's great to see you again. So once again, Powell being very hawkish, as we could say, just in terms of the fact of what could maybe be necessary to get inflation under control.
Yes.
You're not buying it. You don't think we'll see another rate hike. Why?
I don't think we should see another rate hike. In fact, I think the Fed should have hiked in May and then go away. We haven't even seen the full extent of the damage to the U.S. economy of the first 500 basis points in rate hikes. We paused in June. Now we're going to come back in July and hike again. What's changed from June to July? I recognize inflation is well above their target, but it's likely to remain well above their target for the next couple of years. So my concern is if they continue to raise rates aggressively, that's going to push the economy into a deeper and perhaps more protracted recession than would have otherwise occurred on its own.
And yet, Kevin, since the FOMC meeting, we have heard the Fed chair have a very consistent message saying essentially the rate hikes are not over, even if they come at a moderated pace. So, I mean, what's your sense? Is he just dangling this over the market?
Well, it's a good question, Akiko. Remember, there's three tools in the Fed's arsenal to help combat inflation. One is the Fed funds target rate, which they've now raised short-term interest rates 500 basis points over the course of the last 15 months. Two is the size of their balance sheet, which they continue to shrink to the tune of about $95 billion per month. And their third tool is their rhetoric. And that rhetoric is in full force right now. So I'm still in the camp that in all likelihood, they should be done with this rate hike cycle, although we may see one more 25 basis point hike between now and the year end. But regardless, we're at the end of this rate hike cycle. And I believe in all likelihood, this time next year, we're going to be talking about rate cuts, not rate hikes.
This time next year, you think we'll be talking about rate cuts? I know a lot of the expectations for rate cuts have been pushed out well into 2024. I want to go back, though, to what you said just a moment ago, and that was about recession. If we do see two more rate hikes, you mentioned the potential for a severe recession. How severe? What does that look like for the equity markets?
Well, let me put it this way. 70% of our economic growth comes from consumer spending. We know that the consumer continues to spend. The labor market is relatively strong. But we also know that the consumer continues to dip into their personal savings and put more on their credit cards to help keep up with these inflated prices. Last year alone, Shauna, $180 billion worth of new credit card debt was put on the books, a record total. The average of the last 10 years is only $43 billion per year. We also know that credit card interest rates are near 21%, an all-time high. If the Fed continues to raise interest rates, that's only going to make the cost of paying off that credit debt even higher, and that's going to slow down the economy.
So, Kevin, we've got a majority of S&P 500 stocks now up on the start of the year. Can we expect more market breadth, though? We've been talking so much about the concentration in the tech plays, but it's starting to broaden out.
It's starting to broaden out. But though I will point out that if you look at the three major indexes at the midway point of the year, NASDAQ up around a 30% year to date, its best first half since 1983. The S&P 500 up over 14%, well ahead most major analyst predictions for the entire year of 2023. But the Dow up only 2% year to date because the Dow hasn't been riding the coattails of those 7 mega cap technology stocks. We need to see more breadth in this rally to feel comfortable that this is, in fact, a bull market rally. I think we will see that during the second half of the year unless the Fed stays too aggressive.
And Kevin, when we think about the themes really of the first half of the year, a lot of the focus has been on the Fed. And then when you take a look at the equity market, the outperformers there, a lot of that focus has been on AI. What do you think are going to be the key themes here or the key focus for investors in the second half? Is it pretty much similar to what we've seen over the last 6 months?
Similar, yes. So AI is certainly the new hot dot on Wall Street, but I would just recall back to the 2000s during the dot-com crash, all of the hype and euphoria around .com and the internet back then. And I would just advise investors to be very cautious before jumping into those AI waters. Make sure you know who you're investing in, make sure they're committed to AI, make sure they're profitable, and make sure they have strong balance sheets. There's two ways you can play AI, right? You can take the larger cap names, the Microsoft with their multi-billion-dollar commitment to OpenAI ChatGPT, or even IBM, who earlier this week announced a significant $4.6 billion acquisition of Apptio. Those are the bigger cap names. But let's look at some smaller cap names too, who are really driving and using AI. ADRs like Nice Limited or even Opera Limited. Opera Limited has their own native web browser using AI based in Norway, and they also pay an attractive dividend. So there's going to be more than one winner to the AI race, so take your time, do your due diligence, blend US and international, and blend large cap and small cap. We think that's the diversification to play AI.
Well, what's the checklist you think investors should be going for? Is it the profitability of these companies? Is it the valuations? You're looking at some of the smaller names, but what's to say those will have similar upside?
I think you first and foremost need to look at those companies that have expertise and commitment to the AI space. In other words, they're not just suggesting that they're in AI or developing AI, but have a commitment to that space and the investment in the balance sheet to support that. You also have to look at valuations, as you point out. Look at the strength of their balance sheet. Make sure they haven't taken on too much debt, which is going to impede their ability to be profitable. AI's got a long way to go. So consider AI in the context of other revolutionary technologies, such as robotics, the Internet of Things, cybersecurity, 5G, fintech. There are different ways that you can play the race in technology that we think can benefit growth-oriented investors, not just for the balance of this year, but for the next decade.
Kevin, how much of that excitement is already priced into some of these larger names? You mentioned Microsoft, their position right now in AI, given the partnership with OpenAI. How much of that, though, has already been priced in given the run-up that we've seen?
Yeah, Microsoft is one of the more fairly valued, and I'll put that in quotes, of the big cap names right now, trading at a multiple, I believe, of around 37. I know that doesn't sound like it's attractively valued, but relative to NVIDIA, it certainly is. IBM, they are really investing a lot into this space right now. 7 acquisitions this year alone, 30 acquisitions since the new CEO took over, plus they have a dividend of over 5%. So I think there's much more opportunity ahead, but look for those companies with a commitment to the space, cash to spend, and also attractive balance sheet. IBM, Microsoft both fit that bill, but maybe there's even more growth in those smaller cap names.
All right, we will see what the performance looks like in the second half of the year. Kevin Mahn, thanks so much.
My pleasure.